Hello, welcome back to my channel. This is Josh Morris, and today I'm going to be talking about trading, risk management, how to calculate the perfect position size for your trade, whether you're using margin or leverage. And this is all for people who want to study trading, margin trading, leverage trading, if you want to be a crypto trader, if you want to trade with Bitcoin, or if you just want to understand a little bit more about day trading and what it is, but you're a bit confused about the risk aspect of it. Now, understanding risk management is a fundamental skill of trading. If you don't understand risk management, then you're almost guaranteed to lose money. So it's really, really important to know how to manage your risk. And by risk, I mean the amount you might lose. So really, you want to lose very, very little and make as much money as possible. Now, if you've watched one of my previous videos, you know already that 90% of traders lose money. So you don't want to be one of those people. So you've got to have good risk management. I've got my notes here. Now, understanding risk management has been something that I've been figuring out for years. So being able to actually put it into note form and break it down to its simplest concepts has been useful for me, and hopefully I can share that with you so you can finally understand how to manage your risk in a trade once and for all. Now, what I'm going to cover in this video, I'm going to cover 5 huge areas, and I'm going to give you some really, really cool stuff. So area number 1, I'm going to cover the basics of risk and reward, what it actually means and how it's useful in trading and how you can make money with it, right? That's the point of trading. You want to make money. Number 2, I'm going to tell you how to actually frame that risk and reward, how you can frame that inside the charts. And I'm going to take you into the charts and I'm going to show you how to frame your risk and reward on a trade. And I'm going to give you 6 strategies, 3 for framing your risk and 3 for framing your reward. How much you might make, i.e. your profit targets, and how much you're going to risk to, i.e. when you're going to say, right, that's it, enough, I'm getting out of this trade. That's number 2. Number 3, I'm going to tell you how much of a position size you want on each trade. Do you buy 100 stocks? Do you buy 3 Bitcoin? How much do you actually know to spend? It's based on your account value. It's based on the price of the asset. It's based on how much you're willing to risk. And I'm going to go into detail into that as well. Number 4, I'm going to give you a trade risk calculator. This is a position size calculator, and you can use it for free, and I'm going to give you access to that as well, so you'll be able to actually just put in one number. And this is what I wanted to do. I wanted to simplify calculating my position size to just one number. So I'm going to tell you what that one number is, and when you put this one number inside the calculator, it will tell you exactly how much of a position size you should have based on your account size and the risk and everything else we're going to talk about. And finally, number 5, we're going to finish off this video with some really cool tactics on decreasing your risk. I'm going to give you 4 strategies to decrease your risk and how to increase your reward, increase the amount you win per trade. So I'm going to give you 3 strategies to increase your reward. Okay, now this is going to be a very in-depth video. I'm not sure how long it's going to be, but I recommend to take some notes or open up a chart yourself and follow along so you can actually see how this is done. Now let's dive into a chart. Now I'm going to be using this chart here. This is Fiverr. So I've talked about Fiverr before. It's a company that I've used as a customer, as a seller on Fiverr. I sell various gigs, and I've made money from Fiverr. So I like the company already. I understand the business model, and I think it's a cool company to potentially trade. Now, this company IPO'd last year, which means it had its initial public offering last year at around June, July. And I thought that's so cool that this company that I've been using to sell for the last 4 years is now trading publicly on the stock market. So I've been following it. Now I haven't traded this stock, but I wish I would have, and you'll see why. I'm going to use this just to show you that risk and reward, it works across any market, across any asset. So I don't just want to stick to Bitcoin, although when I come to the risk calculator, that's going to be primarily for Bitcoin, but this stuff works for anything. So we'll be looking at the Fiverr chart just so we can look at something a little bit different. Now, let me break down the absolute basics of risk and reward and what the minimum risk and reward you actually want to have is. Okay, so now I'm going to click on this icon here, and that takes me to these options, long position and short position. So I'm going to draw one long position, and I'm going to draw a short position. Okay, now, very simple, red is bad, green is good. Really simple to understand. Red is risk, and green is reward. Now, what you want to have is have a 2-to-1 risk reward. Now, what does that mean, 2-to-1 risk reward? Well, you can see this number right over here is a number 1, and that means the size of the risk is equal to the size of the reward. But what I want to do is I want to minimize the risk, so you can see the ratio is changing here, right? And you want to get it to at minimum a 2-to-1 risk reward. So what this means is that your risk is 1 and your reward is 2. Okay, it's very, very simple, which means that if you risk £50, let's say, and we'll go into more detail in this soon, if you risk £50, then your reward is £100. Now, why do you want to have a risk reward of 2-to-1 minimum? Well, the reason why is because if you only trade 50% winners in your trading plan, if only 50% of your trades are winners, literally a coin toss, right? It's as good as a coin toss. You could just be guessing. If only 50% of your trades are winners, but you have a 2-to-1 risk reward, then will you be profitable? Right? Think about it. Of course, you're going to be profitable because your losers, you're going to lose 50, but your winners, you're going to gain 100, right? So if you have 2 trades, one of them you lose 50, one of them you gain 100, you're up in profit. And if you do this across the board with 100 trades, all of them being a 2-to-1 risk reward, you're going to be profitable. But if you have a 1-to-1 risk reward, right, let's bring it back down here. This is a 1-to-1. Then if you have only 50% success rate on your trade, then when you lose £50 on a loser, you only gain £50 on a winner. So you're only breaking even. Now, we don't want to break even when we trade. We want to make money from trading, right? We want to have our winners be substantially bigger than our losers. That's the key for trading. You want your winners to be substantially bigger than your losers. And everything you're going to learn about trading is going to be about minimizing your losers and letting your winners get bigger and bigger and bigger. Okay? So I hope that is sinking in, the fundamental rule of having a more than a 2-to-1 risk reward. And you can have a 3-to-1 risk reward where your winners are 3 times greater than your losers. And some trading plans actually have that. I personally love having a 3-to-1 or more risk reward. And there's various ways you can do that. But that is the basic. Now, it works in percentages, of course. So you can see that a 2-to-1 risk reward over here would be going down, would be risking 7% on the trade. So if the market comes here and it comes down to 7%, we'll get out. And the reward is up to 15%, so that's 2 times. So again, 2-to-1 risk reward. So I hope that's sinking in. That's the absolute fundamental basics. And if you know anything about trading, you probably already know that. So now let's talk about how to actually frame the risk and reward. Where do we put these, right? Because look at this. This right here, this is a 2-to-1 risk reward trade. As you can see, 2-to-1. But this, if I reduce this down here and this down here, this is also a 2-to-1 trade, right? So completely different trade sizes, but both are 2-to-1. So how do you actually frame a trade? Okay, now I'll give you 3 ways to frame your risk on a trade, and I'll give you a few ways to frame your reward on a trade. So let's just dive right into it, okay? Let's move this all over. Now, in the last video, we talked about, one of my previous videos, we talked about M's and W's, okay? So if you know about this strategy here, this is a bearish strategy where it comes to test here. This is where you enter, and then it will go down sometimes. So this is where you have a high here and a lower high here, which creates a sort of M shape, and it breaks out the midline of the M over here. You can see it broke out and then it comes to test it, right? Now there's the opposite, which is a W, and this is a bullish signal, and it breaks out the center of the W and it comes down to test, and that's your trade entry, right? This low is higher than this low. So this is really important, and the reason why I talk about M's and W's all the time is because it helps you frame your risk on a trade. So let's look at the bullet. Oh, hello, I'm drawing all over the place and I didn't mean to. Let me take this over here. So right over here, you'd put your entry, which is the middle point, right on the neckline or the midpoint of the W, and your risk, guess where it would be? What many people think is that it's down to here, the first line. But actually this is called the Noob Stop. I learned this from Brian Beamish over at The Rational Investor. And what happens a lot of the time is that the big boys, the whales, the big players in the market, they bring it down, they crush all of their hearts down here, and they break these lows, and then they just bring the market right back up. So you want to make sure your stop is below the low here. Oh, I'm still drawing. Let me go back to this icon and pull this down here. So you want your low to be right down here, okay? So that is your risk. On a W, your risk goes down to the low, the lowest low of the W. So that is one way to frame your risk. Now, what you're basically saying here is this is a powerful market structure shape, and it should hold, right? Because people have said, we're going to buy it at this level, and it goes up here. Then they've said, actually, we're going to buy it even higher at this level, and then it even breaks the midline here. So the market is very much, we're going to buy, we're going to buy, we're going to buy, and we want the price to go up. Okay, so it's a very strong signal, and that's why it's okay to risk down to here. Now you want to make sure your risk, your reward is 2 to 1 at least, and this reward should line up with something, and we'll talk about that in a minute. Okay, let's talk about this in the M shape. Now I'm sure you can figure this out because it's just reversed. You put your entry by the neckline, you put your risk up over here at the top, and your reward has to be at a 2 to 1. Right? So now you're starting to understand how to frame your risk in a trade. Okay, so let's remove all of this because I think you understand that so far. Now let's take an actual example on the charts here, because we are on a chart, right? We might as well use the chart. So let's look for a W, okay? Now we'll use a line pattern just so you can see the W shapes. Now maybe pick out a W that you can see and see if you can frame a trade. So I'm seeing, and I'll take off the magnet, I'm seeing a big W over here. You see that? You've got a big W over here. It's come all the way down. This is one low. It's come to a midpoint. It's come to another low, which is higher, and then it's broken out of that midpoint. Woohoo! It's broken out of the midpoint, right? And it actually comes down to test this midpoint right here. So where would you frame your trade? This is obviously a bullish setup because it's a W. So you would frame your trade. This would be the entry at the midpoint, at the neckline, right at the midpoint of W. Your risk would be down here at the base of just below the low, and your reward would be at a minimum of 2 to 1. So you would have a 2 to 1 trade right over here. And guess what happened? The trade came up, it came down, it almost hit your target, it came back up screaming again. You just leave your target there, it comes back down, you get filled over here, and your target is filled, you're in the trade, and woohoo! You've now hit your profit target, you're out of the trade, or you've taken some partial profits, we'll talk about that later, but that is a profitable trade just based on that W, okay? So let's go back a little bit. You can see the application of how to frame your trade in a real life chart. This is in the Fiverr chart. If you would have seen that, if I would have seen that, then you would have made 2 to 1 on your money, right? So that's a good way to frame a trade. Now the next way to frame a trade, and this is a little bit more complex, but it's based on candle patterns. Now an M or a W is considered a market structure shape, because it's a structure of the market, believe it or not. And another way to calculate market structure is by using candles. So these are daily candles. Every single candle here is 1 day. Now we can go to weekly candles, where every single candle here is 1 week, right? So it takes a week to make this candle. We can go to the 4-hour candles, where each one of these candles is 4 hours, and you can see that as you go down onto lower time frames, the market's just like brrr, it's just like crazy. So I like to look at the daily because it's a very strong time frame. Now there are many different candle structure shapes, but what you want to do is you want to, of course, be using your reload zones. So we talked about this in a previous video, where you find the base and you draw a reload zone from the bottom to the top, and then you've got an area here called the reload zone, where the market likes to come and reload, right? So what you would do is you would wait for the market to come down into this reload zone, and you would look for a bullish candle turnaround. Okay, so what does that mean? So for example, you've got a big red candle here and you've got a green candle here. Now in order to frame the trade around this green candle, what you would do is, and this is generally how you use candlestick patterns when you're framing a trade using the candle, you put your entry at the top of the candle or at the clothesline of the candle, and we will have another video soon talking about candles, so look out for that. You would put your stop, your risk window, below the bottom of the candle, and of course you're looking for a 2-to-1. Okay, so 2-to-1 right there. What would have happened if you would have taken this candle pattern, if you would have framed your trade around that candle? Well, check this out. The market would have ignored you, and then boom, right here, it's come to your entry. Then it goes up again, and then it doesn't hit your target, and comes down to your entry again. So you could have entered twice if you really wanted to. And again, 3 times right over here, and then woohoo! And then it goes. Okay, so you framed your trade around this candle. That's another way to frame a trade. So we've talked about 2 ways to frame your risk on a trade now. Okay, so hopefully you're starting to see how to frame your risk on a trade. You're not just guessing, you're not just putting this here and making a 2-to-1, because you can make a 2-to-1 on any size of a trade, right? You're not just putting this over here and risking over here, which would also be a 2-to-1. If you put this right over here, that would be a 2-to-1, but you know, it's not as guaranteed. You want to make sure you have some protection. So by doing it with a candle structure or a market structure shape, you're saying that this market structure shape or this candlestick pattern is going to protect my trade, right? The market doesn't want to go past that. And we call this an invalidation, right? So let me just close this. The reason you want to get out of a trade is because your original thesis has been invalidated. So let's say we have a W here, and this is really important, so listen up. You have a W here, and you've said, right, I'm going to frame my trade. I keep doing that. I'm going to frame my trade around this W. Why do you want to get out at the base here? Well, the reason you want to get out is because if the market comes down and breaks this level, then this original bullish structure that you've had has now become invalidated. The market has told you, no, you were wrong, that W is not as strong as you think, and we could go anywhere from here. It could scream up, it could scream down, you don't know where the market's going to go because your original thesis was wrong. The W was not valid, right? So it was broken. And the same with a candle pattern. You're saying that this candle pattern over here is a strong reversal in a reload zone, right? But if the market over here came down and broke that level, then you would have to be saying to yourself, I was wrong. That candlestick pattern has been invalidated and I want to get out of the trade. You never want to be in a trade where your original thesis was wrong because you don't know where the market's going to go. You were wrong. And part of trading is being able to admit when you're wrong. Okay, so it's all about invalidation. Now, the last method is called the 3 high, low, stop method. Now, this is a bit more of a complicated method, but what you want to look for is 3 lows or 3 highs in the market. So right over here is a low, let's say, because it came down, it went up on that level. This is a low because it came down and went up on that level. And this right here is a low because it came down and went up on that level, right? So that's a 3 low method, or 3 high method if you're shorting, okay? Now, wherever you, I keep doing that, wherever you enter this trade, let's say you enter right here on this 61.8, it's come back down to the 61.8, you would put your risk below the 3 stops. So this is 1 stop, this is 2 stops, and this is 3 stops. So you'd put it down here. Now that's a very large risk window. So of course you have to have a 2 to 1. So here's your 2 to 1. And of course, as you can see, the market, if you would have entered here, it would have come down a little bit and then of course screamed into profit. So you would have done very, very well with this trade. So that's the last method of managing your risk. Now again, if the market comes down here and breaks this stop, you still have this next one as a protection. If it breaks that stop, you have the third one as protection. If it breaks that stop, you know your thesis is invalid. But the point of this is that this is the safest way to manage your risk, because you're basically saying that the market decided that it didn't want to go down anymore here, right? It decided it didn't want to go down anymore here, and it decided it didn't want to go down anymore here. So that's 3 times that the market said, we're not going down below this, we want to go up. So you want to be in that trade moving up, and that's why that is a good way to manage your risk. So that is 3 ways to manage your risk, with the M's and the W's, with the candlestick patterns, and with the 3 high, low, stop. And again, the reason you want to use those is because that is a way to check that your thesis is either valid or invalid. And if it's invalidated, you get out of the trade, okay? Now, how do you frame your reward? Right now, all we've been doing to frame the reward, the amount you might gain on a trade, all we've been doing is using it as a 2 to 1. And at the very minimum, that's what you need to do. Remember, at the beginning of this video, we said at minimum, you want to have a 2 to 1. And if we only stuck to that, then every single one of the trades I just would have said have been profitable. But how is another way of framing your risk and reward? So one of my favorite ways is to use previous market structure, or previous market, size or ranges, let's say. Ranges is the correct word. So you can see the market IPO'd and it opened up at around, opened up around 25, jumped up to 44, and this now becomes the top of the range. So I'm going to put the magnet tool on. So again, you would draw Fibonacci's, and this is a way that I frame my reward on a trade. So it's one of the ways. So here you go. You've got from the top, and I'm going to draw it to the bottom. Okay, now again, in the previous video I've talked about Fibonacci's. What is it trying to say? The market has come all the way down here, and the Fibonacci tool is saying, where will the market retrace to? So just like we drew this one here, the market went from the bottom to the top here. Where's it going to retrace to? We can assume the 61 to 78.6 is a good area it might retrace to. So the market came down here. Where's it going to retrace to? So we draw our little sexy boxes right over here, 78.6 to 61.8, and this is a red box because it's an area that the market is going to retrace to the upside, so it may go down from that point. So these are areas where you can frame your trade to. Now, because this is a take profit target, then you can use the 38.2, the 61.8, the 70.2. You can use any of these to frame your trade, and that's really dependent on your trading plan. Now, I also use the 50% mark, which is not a Fibonacci ratio. It is a Gann study. WD Gann was famous for this. I recommend looking into him. I'll maybe do another video on that. But that is another area to set your target. So let's break this down a little bit. Let's clean up this chart. Let's say the market came down here and we've drawn this tool. Let's say we are sitting here on the I don't know, the 11th of November. Let's just put a vertical line here. We're sitting here on the the 11th of November last year, and you're looking at this market. You've got this massive range here. So you can say the market stopped over here. So you can say that the market is going to come back to here. We can think it's going to retrace. And let's break this down. We've got a low here and a high here. Remember, this is our high because it's the 11th of November and this is the last high we've seen. So we draw a reload zone from the bottom to the top here, and we can say that the market is probably going to, since it's come up here, it's probably going to retrace down to this 61.8 area. Okay, so this is a green box because it's a bullish retracement. It's come back down into a bullish area and it's going to hopefully go back up. So what would we have done? Let's say we entered our long position down here. We've put our, forget the original part where I talk about framing the risk with using M's and W's and everything like that, and just let's say we entered blindly on this 61.8, which is a really great place to be entering trades. I'm not recommending you blind trade this, but that's a good example. Now I've put my order at this is 61.8 and I frame my risk down to the bottom here. We also do have a W here, if you can see that. This is quite a nice little cute W. So again, we're on the 11th of November. We've got this W here, where it's come back down here, and it's put in maybe a W within a W. So already, it's lower than this level, so we know we can frame the trade here. How do you frame the risk on a W? Of course, you do it to the bottom of the low. So we've got the bottom of the low here, and here's your 38.2. So you drag this up to the 38.2, and let's see if it creates a 2-to-1. Well, look at that. Pretty much spot on the dot, 2-to-1. This is what we call a manufactured trade. The big boys, the whales, they know exactly what they're doing here. They pull it down to an area where they can get in at a 2-to-1 risk reward, and right here the market just stopped. It just completely stopped. You can see this. It came screaming down to the 61.8, stopped dead, and it disappeared beyond that, right? My target is 38.2. That's just one target. So that is how I would frame the reward on a trade. I've framed my risk by the bottom of the W. I frame my reward with this 38.2 retrace, which is called the first stop. It's where the market usually stops first, believe it or not. I can also frame my trade up to the 50%. Now, this is one of my favorite areas because the market loves to retrace 50%. Okay, it does this so much of the time. And right here, we would see we would have a 2.85 risk reward. That is greater than a 2-to-1. And if we'd taken that trade, we would have been very happy with that. Now, we could also frame the trade up to, the reward up to the 61.8. And also that one would have been hit as well. And actually this one was the correct one because this one was clearly the one where the big boys said, right, that's the trade we wanted. It's a 3-to-1. And I did say I love using a 3-to-1 risk reward. So this would have been a great trade and immediately, boom, it dumped from there. So that would have been a really great trade. Now, let's say you got out over here, the market dumped, and then you're like, okay, this is the top now. So I'm going to redraw this Fibonacci because, that one's a bit old now. So we redraw it up to here. Let me stick on a magnet. We redraw up to here. Now we've got this reload zone right over here. Okay, we've got this reload zone right over here. So let's do the same exact thing. We've got our entry here at the 61.8. Our risk is down below the bottom here, or it could even be below this low, right? It depends on how you're framing your trade. It depends on your trading plan. I've given you multiple methods, but let's use the 3 low stop method. So it's all the way down to here. If I wanted to have a 2-to-1 risk reward, I would have to target the 78.6, okay? So I've entered here at the 61.8 of this range. My target is the 78.6 of this range. And look at that. The market came screaming down into my order. It maybe made me feel a little bit anxious right down around here where I'm like, I'm gonna lose money. And then it takes off straight to the 78.6, and that's a very profitable trade. So you can see that framing your reward around previous range numbers and retracements is a really powerful way to frame your trades. The next way and this is the way number 2, is to use gap levels. So let's give an example of a gap, and we'll only mention this quickly. Right over here, you can see there's a gap right over there, right? So that's a gap level. Right over here, you can see there's a gap, and that just means there is a gap, there's a space in between the trades. Right over here, you can see there's a gap between this red candle and this candle. There's a little gap. So you want to try and look for these gaps and use them as potential profit targets. Now on this particular trade, there don't seem to be any gaps up here, so it's not something I would use. But let's say we were framing a short trade from up here, you may say that this is a target as a gap. Now I won't go into more detail on that just because I don't want to confuse this at all. The third method is Trendline Tag. So if the market is screaming into a trend line, and the way you can draw trend lines is like this. You take it from the bottom and you draw it to the next bottom, and this is only a valid trend line if it's created market structure, and then your target can be the trend line. So that's another 2 methods. I won't go into detail with those because I want to get to how much you want to actually risk on each trade. What is the position size you want to risk on each trade? And the reason why this is so important is because if you don't know your position size, then you're going to be entering too much or too little, and your risk reward won't be that good. So let's talk about this for a minute. Okay, we're going to move on from the chart and just talk about how much you want to risk on your trade. Now this is huge. There's a rule in poker, which is you never want to risk more than 5% of your overall capital. So if you have £1,000 in the bank, that means that you only want to risk £50 on each trade. Okay, so I hope that makes sense. You have £1,000 in your bank. 5% of that is £50. So you never want to risk more than £50 on a single trade. So this brings up a lot of questions. You know, if you can only risk, if this risk over here can only be £50 of loss, how much do you need to enter right over there? And I pored over this question for months before coming up with this position size calculator, which I'm going to introduce to you later. But it's a really important question, and I basically came up with the formula where you have, and I've drawn it here, I'll happily draw it on the screen. You have your account size times by your account percentage risk, so £1,000 times by 5%, so that's your risk, £50 risk, divided by the trade risk percentage, which is this percentage here. So this is 29%, and what you get is the position size. So this is really, really great. So let's try this, okay? So the way you want to do this is to have your account size over here, 1,000, and then you times by the amount you're going to risk on the trade, then you divide that by the trade risk and times it by 100, which creates a percentage. So now you know that on this particular trade with 29% risk, you want to put into the trade $172. Let's say it's dollars. Okay, now let's just see if this works. How much did we say we were going to risk? £50 or $50. 172 on the position size. So we've entered with $172, 172, and we're going to times that by 29%. And you can see we're risking $50. Okay, so if we entered 172 and it broke this low and we exited, we would have lost $50, which is 5% of our account, which works. Now, what if this was a lot smaller? This was, let's say, 12%. Still a 2 to 1 here. This was 12%. So let's try this again. 1,000 times 5%, which is our amount we're going to risk on our entire capital. Okay, and what was it again? It was 12%. So times by 12, it's divided by 12 times 100. So that's 416. Now let's test if that works. 416 on the trade. Beautiful picture of Charlie Munger there. Don't know how that came up. 416 times by 12%, 49. $50 risked on the trade. So you can see that's how I came up with that formula, where no matter what the position is, you always risk the same amount. And here's an example, okay? So here's all of these trades are 2 to 1, as you can see. Even though they're completely different size trades, they're all 2 to 1. This one is 2 to 1, 2 to 1, 2 to 1, 2 to 1. And that's because it's a ratio. It doesn't matter about the size. But this one you're risking 22%, this one you're risking 12%, this one you're risking 5%, and this one you're risking 2%. So this is where leverage comes into it, because let's say you have £1,000 over here and 1,000, and you're going to times that by your 5% risk on your account. You're going to divide that by the 5% times 100. So you're going to put 1,000 on the trade. Now, obviously that would have been obvious to you because if you're only risking 5% on your account and you're risking 5% on the trade, then obviously you can put £1,000 on the trade, $1,000 on the trade. So you could put your entire account on this trade because the risk is still only 5%. But what if the risk is only 2%? Okay, and this is where it starts to get complicated. Let's do this formula again. This now is 2%, right? So you need to put 2,500 on this trade, right? 2,500. And if you think, okay, I don't have 2,500 in my account, I only have 1,000. Or how can I put 2,500 on a trade? That's so dangerous. No, it's the exact same amount of risk. Because look at this, 2,500 times by 2.5%. Oh, hello. That's 25,000. Times by 2.5% is 62. So I think it was 2.3. Okay, so it's around $50. But that's how it works, right? So if you would have put 2,500 on that trade, you're still only risking $50. So how can you actually put 2,500 on a trade? This is where leverage comes in. With leverage, you can use more than your account balance. So if you only have 1,000 in your account, but you use 5x leverage or 5x margin, then you can put 5,000 on a trade. So this is where leverage becomes really important. Now, when would you ever want to do a trade that small? Okay, well, usually this is where it comes to the day traders, right? Where you're taking trades, and I drew one down here. Okay, we've got a reload zone right here. Just a little reload zone. We've got 61.8. It's tagged the 61.8. You take a tiny little trade down here, right? You're just risking down to the bottom of here. You're taking a trade up to here, and it's a potential trade. I'm not going to go into the details of why this is a potential trade, but it's a 2 to 1 risk reward trade and 1.75 risk. So you'd be able to put on like 3,000 on this trade and still only be risking $50. So I hope this is making sense. I know this is a bit of a confusing part, and it took me ages to actually figure this part out, and that's why I've come up with the position size calculator, which I'm going to show you now. And you can use this. This was made for Bitcoin. Oh, by the way, if you would have gotten on any of these trades on Fiverr, look at this. Look at what actually happened. Your actual risk on this trade, although it was you know, only 17% risk. So if you wanted to risk $50 and you have 1,000 in your account, you would do this formula: 1,000 times 5%. That's your $50 risk, divided by the 17% risk on the trade, times by 100. That makes it a percentage. You'd only put $294 on this trade. Fine, $294 times by 16%. That would have been $50 of risk. But look what would have happened if you would have kept some in the trade. 214% profit. So 294 times 200%, you'd have made almost half your account size on this one trade. It's incredible, right? So the options, especially with stocks that you really like, are really, really limitless. So really quite amazing. Now I'm going to dive into the trade risk calculator, and then I'm going to finish off this video with some important aspects on how to decrease your risk and increase your reward. I hope you're enjoying this so far. I hope I'm not droning on too much. This is the position size calculator which I've made for you, and you can probably get it in a link below, or I'll put a link on the screen or something. So as you can see, the reward on the trade is up here. That's the percentage reward. This is the risk reward ratio, which you always want 2 to 1, and this is the risk on a trade. Now let's just go through what all this is. First of all, you can put your account size, and I use this for BitMEX, so the account size is in BTC, but if you're using a stock portfolio or you're using any other account, you can just change this to dollars. Now, I've made this automatic based on the BTC price. The BTC price here is filled in based on Google Finance, currency, BTC USD, so that's automatically filled. So you don't actually need to touch that, that's automatic. The only thing you need to change is this BTC price, which I've put at 0.05, so that's assuming you only have $500 in your account. Amazing, right? If you have $500 to start with, that's great, because again, it doesn't matter how much you have, it matters how much you risk, okay? So you can keep going. And I'll give you an example. So this automatically calculates based on that, and then this automatically calculates based on the conversion from USD to pounds. So I now have my account size in dollars and pounds. Now this is the one number right here, the 4.47, which you want to change. That's the only number which you have to change, and I'll break down what happens when you change that number. So let's go back to Fiverr and say we've got 16% risk here, 16%. So that's this number here, that's your risk on a trade. So you'd put in right over here, you'd put 16, and you'd click enter. Now you can see a few numbers have changed over here. If you didn't see that, let me put back to the 4. You can see the position size changes and your risk on capital changes. So 16, or your risk on capital doesn't change because that's based on your account. Now let's talk about how this works. Now we've talked about 5% risk on account. That is the absolute maximum you want to risk on any given trade. The reason why is because even if you get a string of losers, you get 10 losers in a row, you're still, which is very rare, and I hope you don't do that, especially if you have a 50-50 chance of succeeding on a trade, which is just a coin toss. Even if you got a string of losers, if you only risked 5% of your account on each trade, you'd still be doing very, very well. Now, as a beginner, you really should be paper trading, which means that you simply just draw this on the chart, you go into a logbook, and you say, you know, I'm gonna enter here, I'm gonna exit here, and this is my screenshot, right? You take a screenshot of the trade, and to do that, you take a screenshot here, you take this image URL, you put this over here, or you put this over here, you know, you put your entry as wherever your entry was, so here it's 17, entry, or you put your exit over here, and you put your risk over here, you know, how much you're going to risk down to. So you risk down to, what is it, 12, 15, so you risk down to 15, you enter at 17, right? So you just enter your log, and that's it. You don't actually take the trade, you don't actually put any money in, you just enter it into the log. That's called a paper trade. So I recommend doing that. But if you are actually going to trade as a beginner, I recommend using just 0.1% position size, 0.1%. So that's this beginner window here. So if I was to risk 1/10 of my account and I only had $500 in my account, that would be 50 cents risk on a trade. My position size would only be $2. And the leverage required is 1, which means no leverage is required. 1 means no leverage, right? If you imagine 1 times 5 is 5. It's 0 leverage. But over here, you keep going up. And if you start doing well with your beginner trades, you get a 50% success rate or more at a 2 to 1 risk reward, you know you're profitable. So you can take it up a notch. You can go to 0.5% of a trade, 0.5% risk on your capital. Normal is just 1% risk on your capital. That's my favorite way to actually trade, with 1%. And expert, when you're doing really, really well, or you're in a winning position already, then you can up it to 5%. But don't go any more than 5%, please, because if you start betting 50%, or you know, if you start putting 50% on a trade and you're risking $200 on an account size of $400, you only need 2 trades incorrect and you're out. You're gone. You're not a trader anymore. You're part of the 90% that lost money. Okay, so don't do that. Don't blow up your account. Don't be stupid. Keep it safe. It's about longevity. You're not trying to run a sprint here. This is a marathon, right? You want to be this in the long term. It's about consistency. It's not about the big win or the big loss, right? I hope not for you. If you're watching this channel, then please, 5% maximum. So this is your expert level trade. Okay, now if you can see here, as soon as I adjust my account size, let's say I have 1 Bitcoin in the account, watch how my risk on the capital is going to change, my position size is going to change, and the leverage is going to change. Maybe the leverage didn't change, okay? That's because of the position size here. Remember when we talked about how if you have all these different position sizes, only when you start getting into the really low percentages, that's when you might need leverage. So let's say, actually, for example, we took this trade down here. We drew this 61.8. We got into the trade here. And we risk down to here. So we got 7% risk. Okay, so we got 7%. We put that over there. One number. And still we don't need any leverage. Okay, so really you don't need leverage that much. But let's say you were doing a trade really on lower time frames, or you were doing a trade on, the 10-minute charts, and whenever you trade on these tiny time frames, 10-minute charts, you end up getting these very, very tiny risk windows. So let's say you took this W right here, this W came in, and you just entered, for example, this W, if you have a look, I don't know when this is, this is the May the 20th, so this is quite recently. You had this W come in, it broke with this, and then you're just going to say, I'm going to enter anywhere here. You could have drawn a reload zone from here to here and say that I'll enter maybe at the 38.2. So you enter at the 38.2. I'm just giving an example here. This is not my trading plan. I'm just saying as an example, you can see that if I risk down to the bottom here, that would be a 2.6% risk. And at 2 to 1, it's 6% reward. Now, this looks like a large trade. But if I go on to even the daily here, you can see that, where is that trade that I just drew? Right? You probably can't even see it. Look. Oh, cancel, don't do that. Oh, don't go back. Look at this. You can't even see it down there. Where is it? Is it this trade? No? Oh, it's here. Look at that. It's tiny. It's so cute and tiny, right? So you would have just taken this little trade. It's in the middle of this range, it's just a crazy tiny trade. But if you're trading on the 10-minute time frame and you happen to be like a day trader and you're doing things like that, then you might have taken this trade based on that W, and you can see this works on any time frame. Okay, so you would have taken that trade, 2.6% risk reward. So you would put 2.6% risk reward, and you can see finally, in order to get that $500 risk on capital, remember I've put my account size to 1 BTC right here, I would have had to enter a position size of 17,000%. So let's just do the math right here. $17,000. And remember, I have $9,000 in my account. Okay, so 17,000 is not that much when you think about it. So 17,000 times by 2.6%. You can see I'm risking $400 on a trade. $400 on a trade. Now that is only 5% of my account, right? 9,000 times by 5% is around 450. So you can see that I'm still only risking 5%, and that is expert mode. But I only have 9,000 in my account, so I can't actually put 17,000 on the trade. So that's where this leverage comes in. I need to use 2 times leverage, because with 2 times leverage, I can risk up to 18,000 contracts or $18,000, whatever it is, right? So that's where the leverage comes in. Now, if this start becoming stupid, like 0.4%, you can see that the only way I don't need leverage is on this beginner mode. Whereas right over here, I need 13 times leverage. So that would be a ridiculous risk reward. If you just want to see what that looks like, that would be 0.7 or whatever it was, and the reward would be up here. So this is insane trading, 5-minute chart trading, right? Ridiculous trading. I don't recommend it for anyone. But let's say you like the look of this candle right here. You entered on this one and you risk down to the bottom of the candle. You'd be down at 1.5% risk. So you put that in there, 1.5, and it would tell you the position size with the maximum risk. right? I recommend staying at beginner level where you can see even on these really low amounts, you still only have one times leverage required. So hopefully you like this calculator. You can see that I've made it really easy. You just put in one number and it tells you what your position size is based on the level that you're at. I recommend everyone start with beginner, go to easy if you're seeing some success, go to normal if you've got a good trading plan and it's working, and go to expert if you're really confident in your trading plan or you're in a winning position. And I'm going to talk about that in a minute as well. You just change this based on your account size. So let's bring it down to 0.1 and you can see, oh, delete that. And you can see that again over here, if you had a really low trade, you had 0.1, you only had $1,000 in your account, you could still risk $10,000 on a trade and you'd need 10x leverage because it would still only be 50%, $50 risk on a trade. So I hope this is actually sinking in and making sense. As you can see, the safest trades are always the ones with the largest risk window. So if I was to take this trade right here, that is a 16% risk window. So let's put that in here, 16% risk window. And even at the 5% level, you only need 1x, 1x leverage. Okay, so no leverage required. Now, again, you can change these. So 0.1%, you can change these up here. So let's say your normal was 2.5, okay? 2.5. Okay, it's rounding up. Let's say this one was 1. Okay, so, and this shouldn't really be rounding up, to be honest. That's strange that's rounding up. I don't know, play with it. But you can see that whatever your levels are, it will tell you what your risk, what your position size would be. That's how much you actually purchase, that's how much you use in the trade. So that's all for the trading calculator. Now I'm going to tell you a few ways, and I'm just going to look at the camera here. I'm going to maybe show you with the chart as well how you can decrease your risk on any trade and how you can increase your reward on any trade. Okay, so here's the method. What you do is when you draw, this is one of the methods. This is called scaling into a trade. So usually if you have your risk reward, let's say at a 2-to-1, of course, at minimum 2-to-1, instead of entering, and let's say you've got your position size calculated 32%, so you put in here 32%, so you can risk $150. Let's say we have 1 Bitcoin, just so we can make it fun. You're risking $1,500. So instead of risking $1,500 right here, instead you put orders here, 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 at around, you know, what's $1,500 divided by 3? So 500, so you'd put 500 here, 500 here, 500 here, 500 here. So let's say the market, you know, W'd or something, and that's why you're, oh, let's draw this again so it's more on the right line, right? So let's say the market has W'd and you're entering here. Instead of just entering your entire position here, you're saying that I don't know if the market's going to stop right here. You never know. So you scale into the trade because the market could come down, fill this order, stop all those noobs out. Remember the Noob Stop? And maybe even come down just to test this and get your last order before screaming up to your profit target. And it does this all the time. You could see it did it over here. It came down and kept coming down. You can see it did it over here again. It does this in every market. So that's a safe way to scale into a trade. Okay, so instead of your entire position being here, you now have an average position of around here. So if you had to redraw this based on your average position, your risk reward, if you kept the reward the same and you kept the risk the same, your risk reward is doubled from a 2-to-1 to a 4-to-1. Okay, so that's another way to scale. That's another way to increase, to decrease your risk by scaling into a trade. The next way, let's say you scaled into a trade, is to take partial profits at certain levels. So I like to take partial profits at the 38.2 level. So let's see how that would have worked on this trade right here. So I've entered this trade. I've got my first sell order at the 38.2, which you could see is a 2-to-1 risk reward. Let's just zoom in so you can see this. 2-to-1 risk reward, 38.2 profit level, right? But imagine if I had gotten 100% out of my trade at this 38.2. 100% out, I'm out of the trade, I've taken full profits, I'm out, right? But then the market kept going up, so I don't have any left to sell. So I just have to wait. And you would have had to wait patiently for the market to come down back into your order, fine. But what if I only took 70% profit over here? And I just saw where it went. Well, I take 70% profit here, the market comes down, again, wait patiently, and the market goes up. Now I can take the rest of the 30% profit and I've increased my profit. So that's a way to increase your reward. That's a way to decrease your risk and increase your reward. The reason it's decreasing your risk is because now this becomes an Now this becomes an average when your profit becomes an average over here. So your trade has now become a 3-to-1 risk reward trade. So that's a way of decreasing your risk and increasing your profit. The next way, okay, so I'm flying through these because these are really advanced methods, so I just want to give you a few ideas of how you can decrease your risk and increase your reward. The next way is moving your stop to scratch when you hit a profit target. What does this mean? So right now, when you hit this target right here, you've taken some profits, but you still have your stop, your exit trade, right? You're going to sell the position over here. So what you would do is when you hit this target, you move this stop up to your entry level. This is called the scratch level. So what happens is you take profits here, you move your stop to scratch, and then if the market comes screaming down right back into your order here, you'll get out at scratch. So you would have only had profit. Now if it keeps coming down, that's much better than imagine if you had left your stop down here at this window, because now you would have lost money on this trade and this would not be that profit. Maybe you would have broken even on this trade. So moving your stop to scratch is really important. Now many people have different strategies about this. Some people wait until the trade hits 50%. Okay, so what's 50%? 50% is around here, and I mean 50% between your order and your stop, okay, and your target. So this is around the 50% mark. So the market comes down, hits your order here, and it goes up and up and up, and it hits the 50% mark. That is when you would move your stop from down here, down at the stop level, up to the scratch level, right? Now it could go either way. The market could come up to your profit level, or it could come down to your scratch level, and you'd get out at break even. Now, don't think that that's a bad thing. Breaking even on a trade is actually the second best trade. There's 3 types of trades: a winning trade, a losing trade, and a break-even trade. Okay, obviously there's way more types than that, but breaking it down to the simplest. So you don't want to have a losing trade where the market, imagine the market comes up to this 50% level, you're like, woohoo, I'm winning, I'm doing so well in this trade, and then boosh, right? It breaks down and it comes past your risk, and you actually turn a winner into a loser. You don't want to turn a winner into a loser. So that is another reason why you would move your stop up. And the last point here is I'll use staggered orders. So I already talked about that on the entry, but you can also use that on the exit. So instead of just entering one take profit target, instead of entering one target here, you enter a target at the 50%, at the 60%, at the 70.2%, at the 78.6%. Now, what would have happened if I would have done that on this trade? And again, I wish I was in this trade. You would have had it come and hit this target and come down, come and hit this target, and then maybe come down a bit, hit this target, and then come all the way down and hit your scratch. So this target would never have been hit. You would have come to a scratch, but you would have taken 3 profit targets. So you would have been making really, really good profit on this trade. So staggering in your orders. So all of this that we've been talking about today is an effort to follow one trading rule that's really important. Cutting your losers quick and letting your winners ride. And they are the same rule, right? They're not 2 rules. They are the same rule. So letting your winners ride and cutting your losses quick is really, really important. That's why you frame your risk the way we talk about. That's why you only take partial profits sometimes. But again, as a beginner, all I want you to be doing as a beginner is setting, or first of all, only doing paper trades, right? Only trading by actually putting a log in the trade. And I want you to be entering here, putting your order to stop here, your exit target here, and your profit target here. That's it. As you develop more skills, you can put staggered entries and multiple take profit targets and do it depending on what your thing is. Now you can move your stop to scratch when it hits the 50% level. You can move your stop to scratch when it hits the first target. It's really up to you in your trading plan. I don't want to go into too much depth because everybody's trading plan is going to be slightly different, and even mine is slightly different depending on the circumstance or the volatility or the time frame we're on, or many different aspects. I might change my trading plan, and I'll go into detail with that in another video. And I hope you've enjoyed this video. I hope you've enjoyed and play with the position size calculator. I hope you understand risk and reward a little bit better than you did at the start of this video, and I've given you some strategies on how to frame the risk on a trade, how to frame the reward on a trade, how to calculate your position size, how to use the calculator, how to decrease your risk and increase your reward, and hopefully you have a fundamental understanding of risk and reward that 90% of traders out there just don't understand. So that's going to be it for this video. I don't want to make it too long and ramble too much. Thank you so much for watching. I appreciate you. Let me know in the comments if I've helped you understand risk and reward at all, and smash up the like button if I've helped you understand risk and reward and now you feel like you're a slightly more confident trader understanding how risk and reward works in the markets. As you can see, I didn't use a Bitcoin chart, just a Fiverr chart, so hopefully that was a bit fun as well. And that's it for this video. Thank you so much for watching. Subscribe for more trading style videos. I talk about self-development, self-growth, making money, trading, selling on Amazon, all this good stuff. Thank you so much for watching. This is Josh Morris, and I'll see you in the next video. Take care. Have a nice day. Bye-bye.